All right. So, hello there, guys. We are live, and I am going to be getting started here in just another minute or less. And so, I just wanted to just uh, just introduce myself here. I'm Desi Arnaz. We'll be starting in about. All right. Hello, and welcome in. Welcome in. My name is Desi Arnaz, and I am your host here today. And today we're going to be talking about um, a new offering that we have here at the Everly May Capital Group. And I'm excited to be sharing this information with you guys. And I hope you guys find this to be very enlightening and also inspirational. So hopefully you guys can hear me okay. Looks like everything is good on my end. We have a chat, by the way. If you wanted to put comments or anything like that into the chat, you can feel free to do so. I'm just going to post in there, hello, everyone, just to make sure that we are all on the same page. You guys can feel free to do that as well. Reach out to me through the chat. Over the next 30 minutes or so, I'm going to be sharing with you information about our newest offering. It is a mortgage note fund, which, as you guys know, I am the mortgage note specialist. Tawanda says hi. Hello, Tawanda. Thank you so much for coming in. Glad to see you in here today. All right. So let me kind of give you a little bit of background here. I started in the mortgage note business a while back, right? More than a dozen years or so ago. And prior to that, I was a real estate investor doing traditional real estate. And I just like, I never really liked being a landlord or doing anything like that, but I liked the money that real estate paid. You know, I liked the cash flow and that kind of thing. So when I learned about mortgage-backed promissory notes, I realized that I could actually get the money from the real estate without owning the real estate. And for me, that was an epiphany. I was like, yeah, that works for me. And so I don't know, any landlords on here? So put it into the chat if you're a landlord. Let me know what your thoughts are on that as well. So let me share a little, I'll share my screen and show you guys some things here that I think are pretty useful. I'm calling mortgage note investing the best kept secret in real estate. And the reason that I call it that is because most people don't even know about it. Even real estate professionals don't know about it, right? I didn't, even though I used to own a Century 21 franchise and 2 different mortgage companies. I didn't realize what it was. But for those of you that don't know me, I'd like to just share a little bit about myself. I'm a professional investor, and I have been since 1980. It's a long time. As long as some of you guys have even been alive, I'm sure. Okay, because I'm an old man. I'll be 72 in 3 weeks. But I love what I do now. For more than 45 years, I have been investing in real estate. So I share that just to say this is not a hobby for me, right? I've been involved in more than 10,000 projects valued in excess of $1 billion during that time frame. So this is the real deal for me. You know, I'm legitimately in this space. I also manage the Everly May Capital Group, which is what brings us here today, right? I manage the Everly May Capital Group. And what we are is we are a $250 million private equity fund going to be $1 billion fund before long. That's my goal for our fund. We're a $250 million private equity fund, and we invest in real estate related assets all around the country. And we help people do that with their IRAs, their 401ks, their, their health savings accounts or whatever, right? You can even use, of course, your regular savings. And because I help people do that, I'm asked to speak often at national events. For example, I've spoken to retired NFL players about what I'm sharing with you guys today. I speak at events all the time. As a matter of fact, this Saturday, this very week, I'm going to be speaking in Jacksonville, Florida at a wealth preservation summit, in which I'll be sharing with people this very same idea that I'm sharing with you guys today. So the information that I'm sharing with you today is information that is is really used by very wealthy families and very wealthy investors to put their safe money into a high return, high yield space. And what I mean by safe money, right? We all have safe money, money that we say, okay, I can't lose this money. And so we tend to put it into low yield investments like bonds, right? Or like certificates of deposit, CDs, where they don't pay that good of a return. They might only pay 4%. Right now, I think CDs are paying like 4.3% nationally, according to Google, right? So, but that's safe money. You don't have to worry about it. You don't have to lose sleep over it. Well, that's what mortgage notes are. It's safe money. If you can move your safe money into a higher yielding investment vehicle, now you're really winning. And that's what I'm going to show you guys today. So here's the best kept secret in real estate, guys. Don't buy real estate. I know that's a strange thing to hear from a real estate guy, a former real estate guy. What you want to own is you want to own the mortgage on the real estate, not the real estate itself. Okay, that's what banks do, right? Banks don't buy real estate. They own the mortgages on the real estate. They don't invest. They don't flip houses. They don't buy. They don't put money in the stock market. None of that, right? Banks are in the money business and they get it. Now, buying mortgages is not anything new. It's been going on since 1938 when Congress approved the creation of the Federal National Mortgage Administration, affectionately known as Fannie Mae, right? Fannie Mae's job was to create a marketplace where mortgages could be bought and sold, just like stocks are bought and sold on the stock market. So Fannie Mae created something called a secondary mortgage market, and that's where we buy our mortgages, okay? So why do I love mortgage note investing? Let me tell you. One of the main things that I really love about mortgage note investing is that it is contractual. In other words, there's a contract that says how much money I'm going to make, right? It's not market driven like the stock market. You don't know. You put your money into a stock, maybe you'll make money, maybe you'll lose money, who knows, right? You just don't know. You have to cross your fingers and hope. There's no volatility in what we do. When we invest in mortgage-backed promissory notes, boom, we know the return that we're going to get. And I'm going to show you guys a case study that makes that point very clearly. So by investing in mortgage notes, I don't have to deal with tenants or toilets or trash, taxes, any of the T words, right? And instead of collecting rent every month, we collect interest because we're not dealing with tenants, we're dealing with owners, okay? And we don't have to have weekend projects, making repairs. Back when I was a landlord, at one point I had 28 properties, right? When I was a landlord, I was always at Home Depot. My weekends were spent for the most part doing something, right? Doing something on one of my properties. I never liked it, but I had to do it, right? That's just the way it is, right? So I don't have to do any of that as a mortgage note investor, all right? Also, I get hassle-free passive income. I call it mailbox money. Every single month, we get just hundreds of checks coming in. And actually, these days, it's not even checks. It's ACH deposits, right? Automatic deposits into our bank account from people paying their mortgage payments. It's a beautiful thing, guys. And you guys can invest in mortgages as well. So let me show you a case study right now of an actual mortgage that I own. I own this mortgage today, right? And why I think that mortgages make the best investment vehicle. And you should at least have some mortgage notes in your portfolio, in my personal opinion, okay? So here's the backstory on this particular mortgage. It's a little house in Missouri. When I bought the mortgage, a real estate agent told me that that house was worth about $180,000 at that time, okay? The homeowner owed $127,000 to the bank. So they had a little equity, right? Their interest rate is 8%. They had 15 years left to pay. Their payments are $1,215. So $1,215 a month is their monthly payment. And the bank offered this mortgage note for sale. But now the bank is owed $127,000, but they didn't want $127,000 for the mortgage note. They offered it for sale for $104,000. And I bought it, okay? Now, why would a bank sell a $127,000 mortgage note for $104,000? That was one of my questions. And you may be thinking that too, wondering that too. Well, the reason is The answer is I don't know, but they do. Okay. I didn't make the rules. Fannie Mae made the rules, and mortgages are typically sold at a discount. And when a mortgage is sold at a discount, something good happens for me as an investor. I spend $104,000 to buy a mortgage, and the people owe me immediately $127,000. That means instantly I have equity in that mortgage note of $23,000. So if those people were to sell that house the very next month, they'd have to pay me $127,000, not $104,000. So I would walk away with a $23,000 profit, instant equity. That's one of the big things that really attracted me to mortgage notes. But there's more than that. There's also this. When I buy a mortgage note, there's only 3 possible outcomes that will happen every time I buy one. Either the homeowner is going to pay their payment like they're supposed to, maybe the homeowner will pay me off early, or possibly maybe they won't pay, right? It's pretty much it, right? That's what happens when you buy a mortgage. So let's look at how each of those scenarios will impact me as the owner of the mortgage. So if they pay like they're supposed to, then that means I'm going to collect $1,215 a month for the next 15 years. That's 180 months, 15 years, okay? That means that over the next 15 years, I will collect $218,700 on my $104,000 investment. That's not too shabby. And when you put those numbers into a financial calculator, you realize that I have earned 11.5% per year for every year that I was in that investment. 11.5% per year, guys. That's a pretty darn good return, especially for safe money. This is money that's not even at high risk. Isn't that amazing? Right? I mean, some of you guys I know use the risk pyramid where you have your high risk money and then you have your low risk money, right? You put your high risk money into cryptocurrency, and maybe, who knows, you'll hit it huge and you buy the next Bitcoin, right? And you become a gazillionaire. But then, I cannot build my future on that hope. I need something more solid. That's called safe money. And that's where you put your money into a bank CD or to a government bond, you earn 3 or 4%, or you put it into a note and you can earn much better returns. Okay. But let's look at possible outcome number 2. If the homeowner decides after 4 or 5 years that they want a new house, right, and they pay us off early, that happens, right? People sometimes decide, let's move to a bigger house or a smaller house. Let's move to a new neighborhood. Let's move to another state, whatever, right? So let's say 5 years after I bought this note, this homeowner decides we want to sell our house and buy another house. So they're going to pay me off, right? Now, remember this. When I bought the note, they owed me $127,000, but this is 5 years later. And they've been making payments for 5 years. So they don't owe me $127,000 anymore. They only owe me $100,155 now because they've made 60 payments. That's 5 years worth of payments, right? So they made 60 payments of $1,215. That means I've already collected $72,900 and they still owe me $100,155. So all total in 5 years, I'm going to collect $173,000 and some change on a $104,000 investment. That means I make clearly a $69,000 profit on a $104,000 investment in only 5 years. Guys, that's fantastic. You put that into your financial calculator and you're going to see that works out to be 13.5% per year. 13.5. Remember, if they pay me as agreed, I earn 11.5. They pay me off early. Now I collect that $23,000 discount and it boosts my yield to 13.5. Isn't that interesting? But let's look at the worst case scenario, right? They don't pay me, because that's what everybody's always concerned about when somebody owes you money. What if they don't pay? Well, if they don't pay me, I have recourse, just like the bank, right? So let's just say 5 years into this thing, they don't sell the house. 5 years into this thing, they get a divorce. And one person moves out and the other person can't afford the payments anymore. Okay? So what should they do? They stop making payments to me. And once they do that, they enter a state known as a state of default. That means they have defaulted on paying their mortgage. They're not paying the mortgage. Once they've defaulted, I have legal rights as the lender because I am their bank, right, for the mortgage. I I have legal rights. I have the right to repossess that property through a process known as foreclosure, right? And we all know what that is. That's where I repossess the property. So once I repossess that property, it's my house. I own the actual real estate at that point, and I can do whatever I want to do with it. I could move into it. I could let my kids move into it. I could rent it out. I can Airbnb it, right? I could donate it to a charity. I could do whatever I want to do. It's my house. So let's just say, though, I choose to sell that property once I get it back, because that's typically what I do. Once I get a property back, I sell them. So in this case here, when I bought the mortgage, the realtor said the house was worth $180,000, but it's been 5 years. Maybe the house is worth more now. Maybe it's worth less. I don't know. I don't have a crystal ball. But here's what I do know. If we just let's just assume that it stayed the same. It didn't go up, didn't go down. Okay. It's still worth $180,000. So that means I'm going to sell that property for $180,000. So let's take a look at the numbers. Remember, before they defaulted, they'd already paid me $72,900 in 5 years. But now they defaulted. And so I'm going to sell the house and get $180,000 for the house. Okay. I've already collected $72,900. But I have to pay my real estate agent and I have to pay my attorney to handle the foreclosure. So I'm going to subtract $14,000 for those fees, but that still leaves me $238,900 after all the expenses. $238,900 on a $104,000 investment. That gives me a profit above my investment of $134,900. Now, it takes about a year to foreclose. And so in order to calculate my return on investment, I'm going to use a 6-year scenario. That puts me at 17.6% per year for the 6 years that I was in this transaction. Wow. Guys, that's why I love mortgage note investing. Love it. Because one of 3 things is going to happen. And none of them are really that bad. As a matter of fact, they're all pretty good. And the worst case, what seems like the worst case scenario actually turns out to be, for me, the best case scenario. So that's why I love note investing. What are your thoughts on note investing? Put it into the comments if you think note investing is pretty cool. I think it's pretty cool personally. Okay. So now let's do this. Let me show you an opportunity and how you can invest in mortgage notes. Basically, if you're going to invest in mortgage notes, you have a couple of ways you can do it. You can do it actively or you can do it passively. Okay. Actively meaning that you do it hands-on, and passively, obviously, you're not hands-on, right? But as an active, and I'm going to talk today about passively investing with us in our fund. But before I reach the passive part, I'm just going to put on here and share with you guys an example of how you could do this actively. Okay. Now, Martha Rella says it's pretty cool. Thank you, Martha. I agree with you. That is pretty cool. So if you want to be an active investor, of course, you could just go to a bank like we do and see if they're willing to sell you any of their mortgages. That's an option for you. But if you don't have a relationship with them, the odds are they probably won't. Okay. They probably won't. And if you haven't been trained, you probably won't know how to actually vet the note to know if you're getting a good note or a bad note and all that. And you don't know how to service it. So for that reason, I have a one-on-one partnership that I do with people that want to be more active, right? Where you literally partner with me personally and we buy a mortgage note together. And you can use your IRA or your 401k to do that, or whatever you'd like to do, right? If you do that, you're going to find that you're going to get collateral. Your mortgage, your investment is protected by double collateral. The promissory mortgage note is your collateral, plus the real estate itself is your collateral. So it's a very, very secure investment. You're going to earn anywhere from 6 to 8% returns as my partner in these deals. You're also going to receive monthly payments automatically, and they're not super long term. These partnerships I usually do from 3 to 5 years. So, but it's a great way if you want to be active. If you're that kind of person who's more of a hands-on kind of a person, then fine. However, I know that many of you guys are interested in being passive, right? you're busy. You got a lot on your plate already. And the last thing you need is something else to do, right? That's the last thing you need, something else to do. And so for that reason, uh, I'm going to show you guys how our passive investment works. Now, as a passive investor, what you need to do is before I even get into that, I need to give you this disclaimer, okay? I'm talking here about the Everly May Mortgage Note Fund. This is confidential and proprietary information, okay? And this is not an offer for you to invest with us. I'm simply showing you what we do. An actual offer to invest with us is made with a document called a private placement memorandum, a PPM. So if you are interested in what we do after today's presentation, just let me know and I'll send you the PPM so you can get all the details. And then if you're still interested after that, we can talk and I can answer any questions that you might have. So, but that's what that is, okay? So I just want you guys to understand that that's how that works. Now, we are professional mortgage note investors. I have a team of people that work with me as we invest in the mortgage note space. I've been working in this space now since 2013. So this is my 12th year in the space, and my team and myself are in this game full time. We've got all the business relationships and banking relationships. We have the due diligence systems in place and the portfolio management systems. We've got the nationwide network of attorneys and the nationwide network of real estate agents and banks and hedge funds that we work with, guys. We've got all of that so that you don't have to deal with any of that. People that are passive, they literally just partner with us as we grow from a $250 million fund to a $1 billion fund with a B, 1 billion. And you can invest with your IRA, your 401k, your health savings account, whatever it is you want to invest with. And of course, you could always invest just with your savings. Okay. And once you invest with us as an equity partner, you're going to earn preferred returns of 8 to 10%. And those preferred returns means that you guys get your returns from the profits before we do as the general partners. Our equity partners get paid first. Okay. Our equity partners also get monthly payments. So if you would like monthly cash flow or quarterly cash flow, you can have that through this fund because this is an income fund. We're collecting income every single month from all these mortgages that we own. People are sending money in every month. So if you want some of that to help subsidize your lifestyle or to take vacations or whatever you want to do, you can have it, right? You can have it without even touching your principal. 75% of the profits that this fund makes are distributed to our equity partners every year. So if you want to invest in this fund, you will earn your 8 to 10% plus the 75% of profit to boost that 8 to 10% return. And this is a very liquid fund. Not quite as liquid as like a bank account, like a checking account where you can just literally go get it immediately, but you certainly have access to your funds. If something comes up in your life and you need access to your funds and you're an equity partner with us, you can have access to your funds very easily through our offering. Now, we own mortgages on real estate all around the country, right? These blue and red spots show some of the places that we have our mortgages. Our mortgages are held, we lend money and have mortgages with home builders and property flippers, right? Guys that buy and rehab, with landlords, with mobile home park owners, also, of course, with a lot of people that just want to have the American dream, homeowners, right? All of our mortgages are first position mortgage notes. First position, guys. We're not investing in second and third position high risk notes. We don't need to invest in high risk notes. This is our safe money. Remember that. This is all about not losing money. Warren Buffett said, number 1 rule in investing, never lose money. Number 2 rule, don't forget rule number 1. Okay, never lose money. So we invest in the secure things, and it's all secured by real property, as I showed you. 3 possible outcomes, and they're all decent. That's why we love investing in mortgage notes. You get good returns. So let's take a quick look at the numbers, and I'll wrap this up, okay? Our portfolio mix is like this. We have performing mortgages that runs around 60 to 70% of our portfolio. We have underperforming or non-performing mortgages, that's 20 to 30% of our portfolio. And we have private loans that we do with builders and rehabbers and people like that. That's 5 to 10% of our portfolio. Our performing mortgages earn right around 14% on average. Our private lending portfolio earns about 16%, and our non-performing mortgages portfolio earns about 27% on average. So our overall blended return for our fund is about 18%. That's the performance that we have experienced in the past with our other funds, and we expect to experience that performance or better with this fund. And these returns are not market driven. It's not subject to the economy. These returns are contractual. People have literally signed their name on a contract that says, I will pay my mortgage. Okay. So I love it. This is not high risk, guys. This is lower risk, much lower risk investments, but yet the returns that we earn are as if it were high risk investments. I can't stress that enough, because a lot of you guys are out there trying to chase higher returns. You can get higher returns without the risk if you open your mind to investing in mortgage-backed promissory notes, either directly or indirectly. Okay. So in this project right now, we're raising $50 million. Okay. That's our capital raise for this project, this round of capital right now, $50 million. Once we're capitalized, we will be earning a profit of right around $3.3 million per year from this fund, $3.3 million on our non-performing portfolio. Okay. On our performing portfolio, we expect to earn about $4.5 million a year. And on our private loan portfolio, we expect to earn about $800,000 per year. Those types of revenue, that type of revenue will generate about a $5.6 million annual profit for us and our equity partners in this investment. Okay. 75% of that is paid to our equity partners. So if you're an equity partner, let me show you an example of how this could work out for you. Let's say you're an equity partner with us and you invest $250,000, or you're going to be earning a 10% annualized return with that investment. Okay. Which means you're going to make $25,000 per year, right from the top. Boom. You got that. That's a 10% return. However, there is that profit sharing bonus that I talked about, the profit sharing bonus that comes in after you've already been paid your preferred return will add another 3% to 5% to your yield. And so in this example, I'm showing a 3% bonus of $8,200. Add that to the $25,000 that you've already earned, and what you're looking at is a $33,000 return on a $250,000 investment. And this is year after year after year after year, right? That represents a 13.3% annualized return, guys. That's better than the stock market has averaged over the last 70 years, right? Much better over the last 30 years, over the last 20 years. That's better. Without all the ups and downs and risk and losing sleep and wondering, oh my gosh, I hope this thing works out. You know, I mean, stock market's okay, but most people don't really like it. They just don't know what else to do with their money. Well, you guys do now. Now that you have an option like this is good. Okay. Pretty good returns, right? Now, here's something else I want to tell you. This is also willable. If you have family that you would like to leave something to, you can literally leave them the cash flow, right? $33,000 a year for the rest of their life and never touch the $250,000. You could literally leave that for them. And believe me, they'll be happy to get it. Okay. So it's willable. And while we are out there taking care of business and making sure that your money is working in a safe environment where you don't have to lose sleep over it, you can go out and do the things that really matter in your life, guys. That's what this is all about. I know that you guys have better things to do than sit around and worry about your money. You got to have better things to do than sit around and worry about your money. If you don't have something better to do than sit around and worry about your money, then get something better to do. We should not be worrying about money. That should not be on our minds, okay? We should put our money into something that's solid, something that's secure, and that earns, and then get on with life, okay? Get on with your life. If you like this and you want to know more about this, the first step is to do this. Review our executive summary. The executive summary is our private placement memorandum summarized, okay? Review the executive summary. If you love what you see, then get the private placement memorandum and get all the details, and we can talk, okay? If you like it, you can invest with us. If it's not for you, that's fine. There's no harm, no foul, as they say, right? No harm, no foul. So don't sweat that part. But at least review it. The way you get it is you can just text the word invest to me at 951-551-0087, and I will send you the executive summary to your email. Okay? I'll send it to your email. You can review it and then get back with me. All right? So there you go, guys. If you guys like this, if you'd like this, and I hope you do, I'd love to have you guys investing with us. I would really love to see that happen. But if it's not your cup of tea, that's fine. I get it. Now, I know that some of you guys, by the way, guys, that's my full presentation right there for the investment. But I know that some of you guys also want to maybe know how you can create a legacy, a financial legacy for your family, and how your investments can fit into that. And for those of you that want to know that, here's what I'll do. I'm going to share, for those of you that want to stick around for another 15 minutes, I'll show you something called the Family Circle of Wealth. This is a program that I use in my own family, okay? And I've used this program to create a financial dynasty, I guess is what I can call it, for myself and for my family that will last 360 years. And it has literally changed my family for the better. It has been such a blessing for my family and for me. I want to share this with you guys for those of you that want to know how you can leave something really unique for your family. Okay, and it ties right into this investing too, by the way, just so you know. All right. So I call it the Family Circle of Wealth. And I've even written a book on this topic, which you can go to Amazon and buy the book. But if you stick around with me for another 15 minutes, I'll send you an autographed copy of my book. Okay. The Family Circle of Wealth works like this. It has three components. Okay. One is for creating wealth. The second component is for actually growing that wealth. And the third and final component is for managing that wealth, right? And you need all three if you want this to last multiple generations. You need all three. Most people spend their time creating wealth, and then they transfer that wealth to the next generation who never created it, who didn't understand how to do it, and then they lose it, right? And that's very, very, very common. But if you don't want that to be the case in your family, then pay attention, because I'm about to show you something really, really cool. Okay. Now, the investments portion for creating the wealth in this program should be something that is super simple and easy to do, and it should be secure. And the notes that we do, the note fund that we offer, meets the bill. But let me just show you why I say it should be simple and easy. Here's why. Because once, right now you're the one managing your portfolio, you're the one that's making the investment decisions and all of that. And you're into this stuff, right? But most of your family, they're not into this stuff. You know that already about your family members. They're not into this stuff, right? And neither will your heirs be, right? So here's what you have to do. You have to KISS. If you know what KISS is, put it into the chat. KISS. Put it into the chat. KISS. What is that acronym for? Anybody know? I'm going to tell you in a couple minutes. But here's what I want you to know. Your heirs have to embrace your plan, because if your heirs don't embrace your plan, then your legacy plan will unwind, it'll unravel, and it'll fall apart. Okay? It'll unravel and fall apart. Put it into the chat if you know what the KISS stands for. You see, you are not going to be here for 360 years in order to manage your portfolio. Your kids are going to manage the portfolio after you. Their kids are going to manage the portfolio after them. And then their kids, and then their kids. And so if you want to have a legacy that goes on for multiple generations, you have to KISS. Nobody put it into the chat, so I'm thinking you guys don't know. It stands for keep it super simple. Keep it super simple, guys. If you'll keep it super simple, then your kids will have no problem at all. They're just collecting money every month, right? And their kids won't have a problem at all. They're just collecting money because the system is in place to manage everything. And so that's what we're going to talk about, okay? As I mentioned to you already, you need an investment that is simple. Well, our fund is super simple for your heirs as it is for you. They literally don't have to do anything except collect the check. So for creating wealth, our fund meets the bill. I'll put a check mark there, okay? Check mark. Now let's look at growing the wealth. To grow the wealth, I use an account that some of you may have heard of and some of you may not have heard of. I use a special type of account to grow my wealth automatically. Now, automatic wealth growth, that's important too. Again, keeping with the keep it super simple strategy, right? Keeping it super simple. If growing the wealth is complex, then your family will drop the ball somewhere along the line. So I've created this model that's super simple for growing the family's wealth. Let me share with you what it is. Obviously, everyone in this meeting understands what a savings account is, right? You put your money into a savings account and it pays you interest. We all get that. But did you guys know that some financial institutions offer something called a wealth savings account? Now, they use a wealth savings account to attract high net worth individuals to their institutions. That's what they do, okay? And they put lots of perks into a wealth savings account that don't go into a traditional savings account. Lots of little extras. Now, here's the interesting thing. You don't have to be wealthy to have a wealth savings account. Yeah, right. You don't have to be wealthy to have one. And my wealth savings accounts, for example, I not only get interest, I also get dividends. Now, what are dividends? Dividends are payments that are profit sharing with the financial institution, right? They do well, they make a profit, they pay out some of that profit to their shareholders. And because this wealth savings account gives you shares in the company, you actually earn dividends in addition to the interest. And so, for example, my interest and dividends right now are running right around 6% on my parked money. And I want to just stress that parked money aspect. Right now, some of you guys are probably sitting on money in a checking account or maybe even a savings account that's earning less than 6%, but you're not ready to use that money yet. And so you just leave it sit there until you are ready to use it, to invest it or to use it to pay bills or whatever. You just let it sit there, but it's not earning very much. How about this? If it were sitting in a wealth savings account while you waited to use it, it would be earning much more, 2 or even 3 times what you're currently earning in many instances. Mine is earning 6% while it sits there waiting for my next investment. But here's the big biggie. These wealth savings accounts, at least the ones that I have, come with insurance. Every time I make a deposit into one of these wealth savings accounts, I get life insurance added into I get a life insurance policy, and it keeps getting increased and increased and increased. Now, that may not seem like a big deal to you. Maybe you'd rather for your bank to give you a toaster or something, but I like this life insurance aspect because with life insurance, when I die, I know this money is going to go to my family, and I like that. And all I had to do to get the life insurance was change where I parked my money. My money you have to park your money someplace. You have to deposit your paycheck someplace. Why not put it someplace that gives you these types of benefits? You get interest, you get dividends, you get life insurance just because you have your money there. To me, I like that idea. In addition to that, the interest and the dividends that you get inside these types of policies grows tax deferred, just like an IRA. But this is not an IRA, right? It grows tax deferred. And you have easy access to the money when you need it. An investment comes up and you want to get that money, boom, you got it in 24 to 48 hours to go and invest it. Do whatever it is you need to do with it. And you can access it at any age, unlike an IRA where you got to be 59 and a half to access it without penalty. You can access this money at any point in time. And then ultimately, at the end of the day, when you go home to be with the Lord, that life insurance is going to transfer to your family tax-free. Tax-free. So you literally could have millions of dollars in life insurance going to your family tax-free simply because you changed where you park your money every month. When I saw this, I thought to myself, that's brilliant, but it sounds almost too good to be true. So there must be some sort of a catch. And so I started looking into it, and I realized there is kind of a catch. And I'll tell you what that is. Prior to 1988, wealthy families and wealthy individuals were putting tons and tons of money into these accounts. And the government basically said, hey, wait a minute, we're not getting the taxes that we want. And so they limited how much money you can put into one of these accounts. In 1988, the IRS put a limit on how much you can deposit into one of these accounts without, and still get the tax benefits. Right? You can put more money into it if you want, but you lose the tax benefits. And what's the point of that? So to get the tax benefits and all the other benefits that I just showed you, you have to limit how much you put in. However, there is no limit on how many accounts you can have. So you can have as many of these accounts as you want, so you can still put away a lot of money. It's just each account has a limit, right? Make sense? So what I did is I opened a wealth savings account on myself, of course. But I also decided that I'm going to open up a wealth savings account on each of my family members. Now, why would I do that? Well, I decided to do that because by doing this, every one of my family members now has life insurance on them. I have family members who don't have life insurance. You probably have people in your family who don't have life insurance. Well, everyone in my family tree that's, starting with me down, all my kids, all my grandkids, all my great-grandkids, they all have life insurance now. And they will have life insurance for their entire life. Now, I own each of these wealth savings accounts. They don't own the accounts. I own all of the accounts. And it's my money in the accounts, and I can do whatever I want to do with it. But they get the benefit of having each of them has life insurance on them. And which is nice, right? And the way that I do this is as each of them passes, right, 25% of the life insurance premium that's built up in their account goes to their family. So for them, it's just free life insurance. And for me, it's a place to park money where I know I can earn a good return on my money till I need it, right? And all the other benefits that I just showed you. Now, the other thing that I did with my life insurance, with my wealth savings accounts, is I set up something called a family banking system with it. And this is how I fund my wealth savings accounts. I have my mortgage notes, my mortgage notes that I own. The interest that comes from my mortgage notes gets deposited into my wealth savings account every month. And every time I add interest into a wealth savings account, you know what happens? I get life insurance. So I get more and more and more life insurance. But also that money that I put into the wealth savings account starts to earn interest and dividends. And I use the interest and dividends and the original interest that came in, and I put it all right back into buying more notes, which creates more interest, which gives more life insurance, which pays more interest and dividends, which goes right back into the fund again to buy more notes. Guys, you see how that works? Look at how that wealth is growing. That's amazing, isn't it? The other thing that I do with my policy, with my program, my family banking, is I allow my family members, any of my family members that have life insurance on them, adults, they can borrow money from one of these, from our family bank, right? So rather than putting the money back into a new note, for example, I will leave a little bit of money in the account because a family member wants to use it. And I can say, hey, you can borrow some money. You want to buy a car, go right ahead. But you have to make the payments back to the family bank, just like you would have to pay Toyota finance, right? You have to pay Toyota principal and interest for using Toyota's money. You have to do the same thing for our family bank. So you can borrow the money from the family bank. You don't have to jump through hoops with Toyota and hope they approve you and all that stuff. And when they pay the money back to the family bank, that increases the balance in the family bank. And they can use that money to buy whatever, right? And the next time they need money or some other family member needs money, the money is there in the family. Our family members can use this money for home loans when there's enough. Right now, we don't have enough in there for people to buy a house, but over time there will be. Because remember, every family member has life insurance on them. And as every family member starts to pass, as each family member passes, right? Or you could say graduates, the life insurance policies will send tax-free money into our family bank through the wealth savings accounts. So over the years and over the generations, we're going to have literally millions and millions of dollars in the family bank. And the family bank uses the interest and other things that's collected to buy life insurance on the new people that are born or married into the family. That's how this works, right? So that's how we grow our family's wealth, guys. Great way to grow. We can check that one off. Wealth creation, check. Wealth growth, check. Final thing is wealth management. So let's talk about that, right? As I mentioned earlier, it's not unusual for people to pass something down to their heirs and then that money gets squandered. In Scotland, they have an old Scottish proverb that basically says shirt sleeves to shirt sleeves in 3 generations. And basically what that's saying is that one generation rolls up their sleeves and makes some money. Then they leave it for the next generation who didn't have to roll up their sleeves. They just got the money. And so they manage it. And then the third generation, they didn't even manage it. They just squandered it because they didn't have to earn it. They didn't even have to manage it. They just spent it. And that means that the fourth generation has to roll up their sleeves and start all over again. Well, I didn't want that in my family. And if you don't want that in your family, the family circle of wealth will fix that so that it doesn't happen in your family. This is multi-generational, and it fixes it by doing something that's very different. It literally, the family circle of wealth leaves an instruction manual for your heirs on how to manage the family's wealth. How to manage the family's wealth. Most people just leave the money or they leave the stuff. They don't leave instructions. So in order to leave instructions, you should create a trust. Now, I know some of you guys have a trust. I know that already, right? Some of you guys have a trust. Well, the trust that I'm talking about here today is not a living trust because a living trust only lasts for a little bit longer than you do. Living trusts die shortly after you do. So what we're talking about here is something called a dynasty trust. And a dynasty trust lasts for 360 years. That's a lot of generation. And in a dynasty trust, you can pass on not just your stuff, but you can pass on your knowledge, right? It serves as an instruction manual as well for how to manage the family's wealth. You can pass on the life lessons that you've learned. We've all learned life lessons that we would love to see our children and grandchildren and great-grandchildren benefit from. You can pass those on right inside your dynasty trust. You can also pass on your personal values. For example, I'm a Christian, and so I have it built into my dynasty trust. Christian values are built in there, and even Christian behavior is built in there, and it is rewarded financially when my family behaves as Christians. That's all in the trust, and we can talk about that if you decide you want to know more. Also, our investment portfolio is in our dynasty trust. So in essence, the dynasty trust owns everything, right? You don't leave things for your family, you leave things for the trust, and your family benefits from the trust. That's how the really wealthy do this stuff, okay? You don't just leave, I'm going to leave all my money. I got 4 kids, I got $1 million, they get $250,000 each. Guess what? 3 of the 4 are going to squander the $250,000, and in 2 years, they'll be broke again, okay? However, you leave the $1 million in the family trust, and you make it available for all 4, and you put your rules in place. That's a whole different ballgame, guys. It's a whole different ballgame. So that's the secret right there. So the dynasty trust is the third component of our family circle of wealth. So we have mortgage notes to feed the funds in. We have the wealth savings account to grow those funds. And then we have a dynasty trust to manage that whole process. That is the family circle of wealth. Cool, isn't it? Really cool stuff. And as I said, I wrote a book about this. It's called The Family Circle of Wealth. It's available on Amazon, but you can have a free signed copy today. I'll put it in the mail to you. All you've got to do is this. Just text me your mailing address where I should mail the book, along with the word book. Text the word book and your mailing address to 951-551-0087, and I will mail you the book. You can read the book, and then if you decide you want to pursue creating a dynasty trust and setting up a family banking system for yourself, I'll be happy to share with you how I did mine. I mean, I don't make any money from that. I just want you to know that it's a wonderful thing, and once you do it, your family is going to thank you big time. My family certainly has. They continuously thank me. And there's so many more benefits that'll come from it, but I'm not going to take the time today to go through that, guys. So there you have it. There you have it. I hope you guys like what you've seen, right? Oh, let me put this on the screen too. You can head on over to EverlyMayNoteFund.com. Now, that may not be up just yet. My IT guy said that he was having some trouble getting it ready. It's supposed to be ready by yesterday. He was having some trouble, so maybe it's up today, but if not, it'll be up very soon. EverlyMayNoteFund.com. But even if you can't get that there, you can certainly reach me by texting me at 951-551-0087. All right. Was this good stuff, guys? You guys like this? I hope you found this to be good stuff. I thought it was good stuff. And when I did it for my own family, I've never, ever looked back in regret. So I'm hoping that you guys will embrace this at some point, add this into your own family, and again, never have to look back in regret for yourself and for your family. Okay? So there you go, guys. Join me. Invest with us. Invest with us. It makes sense. You don't have to put all your money with us. Put some of your money with us. You'll never, ever look back and regret it. That's for sure, because there's only 3 possible outcomes when you invest with us. All right? Very good, guys. I'm going to wrap this up right now. God bless you all. I look forward to speaking with you and hearing from you very, very soon. Bye-bye.